Hello Accounting 101 students. In this video, we're going to go over some of the topics in Chapter 3 using our student review slides that are included in our Canvas course site. Chapter 3 is one of the most important chapters in this class. It's actually the chapter where you learn how to record business transactions, which is one of the main learning outcomes for our Accounting 101 class. Chapter 3 has several areas of focus, which include the accounting cycle. So you want to learn all of the steps in the accounting cycle that are utilized within our accounting information system. You also want to focus on recording business transactions in journal entries. So that will be the main focus for this particular chapter. You also are introduced to the concepts of posting journal entries to the general ledger and preparing the trial balance. And you can see that there's a lot of information that you'll need to learn that is brand new. Please be patient with yourself. Take some time to really watch a lot of the videos that I've provided to you and utilize our resources with Wiley to assist you in learning about the material and practicing the material. So an accounting information system is the process that we utilize to analyze business transactions, and eventually through this process we're going to be preparing financial statements and preparing our accounting records for the next accounting period. So the very first part of this process is to analyze business transactions. So a business transaction could be purchasing inventory with cash, or it could be paying employees with cash, or it can be earning revenue from our customers, and our customers are going to be paying us later on account. So there could be a number of business transactions, and they vary from business to business, and you want to be able to read through the business transaction and figure out what accounts you learned about in Chapter 1 and 2 are going to be impacted. Once you identify the accounts, you're going to be able to record the journal entry. So the process of journalizing is very, very important because this is our accounting records. And in the journal entry, you're going to include in the date of the transaction, the accounts that are being impacted, and the dollar amounts. Once you journalize the transaction, you're going to summarize them by posting the information in the general ledger. And the general ledger is a list of each account and the running balance, whether you have an increase or a decrease, and what's your balance at a particular point in time. And at the end of each reporting period, the company will take those ending balances from the general ledger to prepare the trial balance. And a lot of this information is really being done electronically these days, but in Chapter 3, we're going to go through these first 4 steps, and Chapter 4 will continue the accounting cycle because you need to make some adjusting entries, and you will have an adjusted trial balance, which is then going to be used to prepare the financial statements. At the end of the accounting period, you need to close out those financial statements that are prepared for a period of time, namely the income statement and the retained earnings statement, so that way you can start recording your transactions with the next accounting period with a fresh new $0 balance for your revenues and your expenses and your dividends. And that will be part of the post-closing trial balance process. So when we think about analyzing transactions, we go to our basic accounting equation. And our basic accounting equation is assets equals liabilities plus equity. And we learned this information is being presented in the balance sheet. Our stockholders' equity section is further broken down between common stock and retained earnings. And we also remember from Chapters 1 and 2 that retained earnings is computed by taking the beginning retained earnings, add net income, which is going to come from the income statement, and you're going to subtract out dividends to get your retained earnings at the end of the accounting period. So retained earnings is going to be impacted by 3 accounts. It will be impacted by the revenues category of account. If you have an increase in revenues, that increases retained earnings, which increases your equity. On this opposite end, expenses are going to reduce your revenues, which will reduce your net income, which will reduce your retained earnings, and reduce your stockholders' equity. Similarly, dividends will also reduce your retained earnings and reduce your equity. And this is an important relationship to note. In this chapter, you learn about analyzing transactions. This is also referred to as tabular analysis. And for this, we start off by taking our basic accounting equation. We have our assets, and then we include in different accounts that are part of the assets category. Your assets are going to equal your liabilities and equity, and you also have your accounts that are considered liability and equity accounts when it comes to account classifications. So when you read a transaction, you want to note the date of the transaction, but also identify what accounts are being impacted. And in this example, stockholders invested $15,000 cash, so that means we received cash. We have an increase in our cash balance because we received money from our investors. When it comes to your tabular analysis, you're going to include in plus $15,000 under the cash account, which is going to lead to an increase in your assets. And we have an increase in cash in the business in exchange for common stock. So our stockholders are going to receive shares of ownership in the company. So we're going to have a corresponding increase in our common stock, which will increase our equity. And you can see that this basic accounting equation balances out. Plus $15,000 on the asset side equals plus $15,000 on the liabilities and equity side. And in our Exam 1 study guide, I have several transaction examples. I have 13 examples, and I encourage you to try to read through these examples and look at the information and determine what accounts are being impacted and whether it would be an increase or a decrease. And I also have 2 videos that correlate with the Exam 1 study guide and these examples to assist you in understanding and practicing how to look at our business transactions. The next thing we're going to be talking about is debit and credit procedures. These are the rules of accounting. So it takes some time to learn these rules, but think about what way would be easiest for you to summarize them in your mind. So one thing that you want to realize is learning the rules does take time, and it's kind of like when you needed to learn the rules to drive a car. You learned green light means go, red light means stop, and you also learned the rules of when you can make a turn. So with accounting, we have a double entry system, which means that each transaction must affect 2 or more accounts in order to keep the basic accounting equation in balance. So this is done by recording a debit to one account and a credit to the other account. So the debits and the credits are opposites of each other, and they must equal in order for your accounting equation to remain in balance. So this slide is a summary of the debit and credit rules, and you can see that for assets, when they increase, there is going to be a debit recorded. DR is the abbreviation for debit. When your assets decrease, that is going to be a credit. So for every asset, you want to remember debits are increases, credits are decreases. For your liabilities and stockholders' equity, this is on the other side of the accounting equation. So that means when you are going to have an increase, it's going to do the opposite. If your assets increase with a debit, that means that your liabilities are going to increase with a credit. And if you have a decrease in your liabilities, that's also going to be a debit. And common stock, retained earnings, and revenues follow the same rules. You have an increase with credits, decrease with debits. And then we get to something that's a little bit interesting. With our expenses and dividends, these are going to decrease our retained earnings, and therefore they're going to decrease the stockholders' equity. So the signs or the terms are going to be the opposite. So when it comes to your expenses and dividends, they increase with debits and they decrease with credits. And I have a little acronym to assist you in remembering this. My acronym is DEALER. That means DEA. I'm splitting up the word or the acronym DEALER into DEA, which stands for dividends, expenses, and assets. Those all have something in common, which is they increase with debits. And on the opposite side, I have LER, which is our liabilities, which is our equity, and our revenue and retained earnings. Okay, so the LER side, they increase with credits. So hopefully that acronym can help you understand some of these debit and credit rules. So in our recording process, we started off with analyzing the business transactions. Now we're going to talk about journalizing the transaction. So journalizing means that you enter the transaction data into the accounting records. So if we continue with the same example that we started off with, on May 1st, which is the date of the transaction, the journal entry needs to note the date of the transaction so that way revenues and expenses are being recorded in the proper period. We note that stockholders invested $15,000 cash, so cash is an asset account. Every time we have an asset account increase, that will be a debit. The account you're going to debit is going to be listed first on the very, very top. So you're going to list cash first. And in the debit column, which is always on the left side, you're going to include in the dollar amount. So you need to look at the business transaction, identify the accounts. From there, figure out which account is going to have a debit and include the dollar amount in the debit column. And we know that we received cash in exchange for common stock. And common stock is going to increase our equity. So when our equity increases, this is going to be a credit. And you will notice that we have an indentation to the right for common stock. And you will include the dollar amount on the credit column. And you can see the amount of debits increase the amount of credits in every journal entry. And in most of our examples, you'll have 2 lines, but in some examples, it's possible that you might have more than 2 lines. But the main thing to remember is your total debits have to equal your total credits for each journal entry. And then a company would record a brief description. In your study guide, I have several examples. So this is a continuation where you first start off with the transaction analysis, and then for those same transactions, you're going to be recording the journal entries. So please take some time to go through these 13 examples in the study guide, write them out, think about what you would choose for a debit or a credit, and then watch my videos. I have 2 videos to go over each of these 13 transactions to assist you in learning how to record journal entries. Thank you for taking the time to watch this video, and I will be continuing the student review slides in a separate video.